Hey, good morning, everybody, and welcome to this Tuesday, excuse me, January 16th, 2024 edition of Earnings of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day and the start of a holiday-shortened trading week. We are moving into the second half of January now. If you recall, back in 2023, we got off to a pretty slow start right at the beginning of the year, but around the 5th or the 6th, things started to improve and we took off. Had a really big January. So far this January, we're kind of in the middle of the month already and really haven't seen a whole lot of strength, even some weakness on the small caps and some of the other areas. So, I thought this January was going to be different. I didn't think we would see that kind of strength like we saw last January. Election years normally result in choppy first quarters. I think that's after a big advance at the end of 2023. I think that's probably the most likely scenario. I wouldn't rule out the market continuing to go higher. I certainly wouldn't rule out pulling back for a little while because I do think that there are some concerns in the short term. I'm going to talk about one of those a little bit later in the show. But I just expect chop, and chop means we could go any which way. But I do think that this is going to be a little bit slower start to the year than we saw back in 2023. And I think that's okay. Again, after a big run up like we saw in Q4, that was totally different than what we saw at the end of 2022. If you recall, 2022, at the end of the year, the Nasdaq was back near the October low. The S&P 500 had rallied a little bit more than the Nasdaq, but still was downtrending, and it looked like we were still potentially in that bear market. But so we had a little different scenario going into 2023 than we did 2024. And I think that makes a big difference as far as expectations go. If you just keep a healthy dose of perspective, try to look at the charts objectively, I think it's pretty easy to see that, when you have that kind of a rally, and it was one of the best fourth quarter rallies we've seen in the history of the S&P 500. So keeping all that, in mind, personally, I'm keeping my expectations a bit lower here as we start 2024. It is an election year, and this is typical, as I said, historically for an election year, for it to get off really to a choppy, slightly up, slightly down kind of a move to begin the year. Let's go ahead and take a look at what happened on Friday of last week. Let's jump right in. The Dow Jones Industrial Average finished down about 0.3%. S&P 500 was up less than 0.1%. Same goes for the Nasdaq 100. Mid caps down less than 0.1%. Small caps down less than 0.2%, and transports down 0.4%. Mostly Friday we finished kind of flat. A little bit up here, a little bit down there. No big shakes. Looking at the sectors, energy finally reclaiming a spot back at the top of the sector leaderboard. We haven't seen that for a little while. Real estate, by the way, energy up more than 1.1%. We had real estate up about 0.75%. Real estate during that rally off of the October low through the end of December, real estate was the number one sector. So that's where we saw a lot of the money rotating. I think it was a combination of things. Obviously, real estate had been hit hard for quite a while. And I think when we went into the fourth quarter and interest rates started dropping, I think that was a perfect recipe for a nice rebound in the real estate area. Finally, discretionary, that was the big loser from Friday. Well, we saw the XLY drop 1.2%. Not really performing that well, here over the past couple of weeks. And we've seen staples outperform discretionary for the last couple of weeks while the market's just been kind of trying to search for direction. That's not that unusual. I do want to point out that from the end of October through December 28th, which is when we topped on the S&P 500, during that bullish rally, the discretionary stocks went up about 2.5 times, or maybe, it was definitely more than a double. I don't remember the exact numbers. I want to say discretionary was up a little more than 20%. Whereas staples were up only about 7 or 8%. So during that rally, it was definitely still a risk-on kind of an environment, which is awesome for the market. but we do have some things to worry about. Again, I'll talk about some of those in just a bit. Looking at industry groups from Friday, computer services, which had been, on a relative basis, maybe a little bit of a lagging group in technology in 2023, saw a pretty big breakout on Friday. So that was an encouraging sign in technology, one of the bigger groups. But some of the other areas, again, we'll talk about some of that in a bit, but it's not all roses right now in that area. Defense had a really strong day, finishing up almost 2.25% on Friday, and you can see threatening a breakout, been in a nice uptrend now since the beginning of October, and another breakout would occur if we can get up through about right around the 610 area or so. Business support services also strong on Friday, gaining almost 1.6%, threatening a breakout as well. These last two groups are both in the industrial area. So we're seeing a little bit of strength in industrials and in financials, which is a little bit more value oriented as opposed to growth oriented. So I think that rotation, if there's one thing that I'm really looking at closely in January and maybe even throughout the first quarter, it's that rotation, because we saw such leadership from technology and communication services, and maybe to a lesser degree, consumer discretionary throughout 2023, to the point where I think maybe it's time that we see some rotation out of those groups. Again, I'll go into some of those charts in just a bit, but it does have that feel of some rather significant rotation into some of the value-oriented areas. Looking at the 10-year Treasury yield, right now we are up about 7, almost 8 basis points this morning on the 10-year Treasury yield, back up over that the 20-day moving average, and currently at almost 4.03%. As far as economic reports go, first of all, today we've got Empire. We already had Empire State Manufacturing Index. I'll get that for you in a second here. Retail sales tomorrow. That's going to be a big one. We also have industrial production. One of the things I pointed out in Market Vision 2024, if you were unable to make it to that, is that one of the biggest signs of a potential recession is watching a falling industrial production number deep in the negative territory. So we had a huge number as we went through the pandemic and we started, everything started coming back in terms of supply. Industrial production went way up after it had gone way down when we closed down and we shut down the economy. Well, since it went way up in about 2021, we've been drifting back, down, and we're back down to around the center line. And I think this is going to be an area to watch in 2024 for those of you who are really adamant that we're going to have a recession. Industrial production needs to continue to drop, and probably rather significantly. And if you see that, I think that is going to be a sign, certainly one of the signs that I watch for to see how likely a recession is. Also, pay attention to the market, what the signals that the market's sending, what's leading market to the upside. Over the course of this latest rally, home construction was the #1 industry group. Home construction. Number 2, travel and tourism. Number 3, recreational services. These are 3 areas that should get killed if we were going into a recession and all of a sudden demand were to drop and we had negative GDP. Those 3 areas I just listed, which have been the best since the October low, should be getting trounced. I mean, who would be moving into those areas if we had a recession right ahead? So some of it is just market relationships, intermarket relationships, seeing what's going up and what's going down. I can promise you that the folks on Wall Street, the big Wall Street firms, they have a ton of talent as far as looking at the economy and what we should be expecting. And then where those Wall Street firms, those big money firms are putting their money. You can see it in the charts. You can't always see it in their analysts and so forth that they send on CNBC, but you can see it on the charts. Follow those charts. How can those 3 groups lead heading into a recession? I mean, come on, common sense. So I'm not buying into the recession fears based on that. If I'm looking at charts, one chart to really continue to pay attention to is industrial production. Anyway, Right now, we're fine with that, but that's going to be one chart that I do watch pretty closely in 2024. So we have retail sales, industrial production, housing market index, beige book. All of those are out on Wednesday. Thursday, housing starts and building permits. Of course, jobless claims, Philadelphia Fed manufacturing index. And then we move into Friday with the existing home sales, consumer sentiment, those types of things. Certainly could have an impact. The various economic reports that we have this week coming up. So Empire State Manufacturing Index out this morning. The consensus estimate was minus 4.7. Last month, and by the way, that consensus is for the month of January, so it is a fairly current report. December's was minus 14.5. We were expecting that number to come down to minus 4.7. The actual number was minus 43.7. So clearly a much bigger drop than what the market was expecting. And this is a report conducted by the New York Fed that surveys businesses to find out, or manufacturers specifically, basically just asking roughly the same pool of 200 or so survey participants, what they're feeling in terms of their views about the likely direction of certain indicators that assess the manufacturing area of the market. And so that was a big drop. So, we got futures down a little bit. Is that going to be a big issue? I don't think so. I think it's probably going to be more of the chop that we're talking about in the fourth quarter. I think there are going to be enough of these reports that are going to maybe make market participants just like they're walking on eggshells a little bit here in the first quarter. I think we could have big moves to the upside. When I say big moves, I'm talking about short-term 3 to 5% moves. I'm not talking about 10, 20% moves. So 3 to 5% moves, but I also think you have the potential of those to the downside. I have given a downside target in the first quarter. I wouldn't be shocked. It's kind of my extreme to the downside. I don't think it goes lower than this, but I certainly wouldn't be surprised to see 45 to 4,600 on the S&P 500 market. Even in a bullish secular bull market, there are periods of time when the market just sets up for perhaps some weakness. And I think there are several indicators that could line up where we could maybe see that drop. And again, where the S&P is right now, we're talking about probably in that 3 to 5, maybe 6% range to the downside. All right, let's keep moving. We'll go into the S&P 500. Here is a potential double top. One thing that I mentioned in our weekly market report yesterday to members was that even if we break out on the S&P 500, I mean, this last week's strength that we saw, the PPO actually looks like it's continuing to drop a little bit. So I'm seeing slowing momentum. And if we make the breakout above 4,800 and set a new all-time high, I mean, it'll be great on the surface, but under the surface, we've got maybe a little bit of a slowing momentum brewing and a negative divergence. So here's the way I'm looking at it. If you go up and you break out, I'm fine to play the breakout and to remain bullish. What you want to be careful about is if a negative divergence is accompanied by a reversing candle. So, for instance, on Friday, we saw JP Morgan come out with a good number. I'll just pull up this chart. But just to show you maybe a little bit of what I'm looking for, something like this. I mean, where you see the big rally that we've had, we get a breakout. It looks like, okay, here we go again to the upside. And then on big volume, we see a very big reversal, bearish engulfing candle, something like this, where I don't know what it would be. We got a couple economic reports out later this week. We'll have earnings reports coming out. It could be something that just makes the market jump at the opening bell, and then we see selling throughout the day. And that kind of a candlestick looking like what we see on JP Morgan, if we were to see that on the S&P 500 with a negative divergence, that's where I would suggest that you be more cautious in the near term. Nasdaq 100, similar type chart. We haven't gotten all the way back to the high we saw at the end of December, but even if we do, it's likely to come with a nasty looking negative divergence. And you can see the last time, July was the last time we had a really ugly divergence in play. And that was back in June, July here, highs. You can see the lows or higher or lower highs in the PPO at that time. And that negative divergence was one of the reasons why I wrote an article, had YouTube videos, reports to members, but that was one of the reasons why I was talking in mid-July that we could see selling. Now, I wasn't saying we are going to go down for 3 months and we are going to go down 10%, but I was certainly discussing the fact that we needed to be cautious at that time. I don't see as many warning signs now as I had back then. So I'm not predicting any kind of a move to the downside like we saw July to October, but I could see a move back down to test 50-day moving averages, maybe even slightly below. And that could get us down to some of those areas that I was talking about earlier on the S&P. Small caps definitely, I was looking at this and I was seeing a lot of gap downs and not really a whole lot of selling intraday. I mean, we had the one day here, another day here, but all of this came on the heels of about, 6, 7, 8 straight days of gaps to the downside. And then we had this nice move back up, looked like accumulation back above the 20-day. Here we go to the upside, and then more gap downs and just sideways action. And Friday's action wasn't very good because for the first time we had a decent sized gap up. That was probably the first significant gap up we have seen in, probably dating back to maybe even the middle part of December. As I look at these candles, well, here was a pretty decent one. But there haven't been many of late. And so we saw that at the open on Friday. So I thought the small caps had a shot to maybe take out that recent high and start recovering, and that did not happen. We didn't break down below gap support, but we did sell off and close near the low of the day. And so that was another one of those bearish candles. And looking at futures today, I'll go ahead and just pull them up here. If we look at the diamonds, we got about 13 minutes to go before the market opens. Diamonds down 0.4%. The spider down 0.4%. QQQ down about 4.5%, 0.45%. And then the IWM getting hit the hardest, down 0.9%. And look at that number right there, 191.52. We go back down or go back here. That is below this 192.67 level. So we're going to open somewhere in an area where we haven't been, which tells me one of two things. We either need to get a quick recovery today on the IWM, or I don't really see a lot of support until we get back into the mid 180s. So that would be another $5 drop on the IWM. Potentially we could see more, much more weakness ahead on the S&P and on the Nasdaq. Again, I just think this is a time for caution. If you're really nervous, you can move more into cash. I would simply say just stay away from leverage on the long side. I don't think that this sets up well right now for leverage. And this is something that, I was thinking that leverage was pretty appealing around here, but I did not like that candle on Friday. And certainly the follow through gap down this morning makes me a little bit nervous in the near term. So kind of watch that and keep that in mind as you trade throughout the day and into the early part of this week. All right, moving on, transports. So transports broke down below the 20-day, and they haven't seen a close back up above the 20-day in about the last 8 trading days. So transports have some work. They're showing a little bit of weakness as well in pre-market. I wouldn't be surprised to maybe see that 15,200 level come into play maybe at some point this week. And that's going to be a big level for the transports in the short term. Again, if we lose 15.2 on the transports, you got the IWM falling below that gap support level. I think you start looking at more and more areas of the market that are in the short term on the way down and below the 20-day moving average. And I think that could potentially drag some of those areas down with it. Moving on to chart of the day. For those of you who are new to earnings beats and maybe new to the show, first of all, welcome. Really appreciate you tuning in. I like to think we look at the market a little differently than most. I do lean heavily on technicals, but intermarket relationships are something I think a lot of folks don't pay enough attention to. And I think that's a big part of technical analysis as well. So if you're looking at why maybe my technical analysis views are different than others, it's because I think a lot of it has to do with the intermarket relationships. Because there are a lot of times when I look at the market technically, just strictly looking at the daily chart and where the price action is relative to the moving averages, where that daily PPO is. Sometimes it goes negative. But if my under the surface signals, these intermarket relationships aren't turning down, or better yet, from a bullish perspective, are turning up, that tells me that the move to the downside on the surface price action is probably not going to continue. So anyway, I put a little bit of a different spin on things. You got to follow who you believe, who you trust. I will say that I will call bearish action when I see it. I'll be cautious when I need to be cautious, but I also do not ignore the fact that the S&P 500 has gone up 56 of the last 74 years. So if you want to bet on the bearish side every year and be pessimistic, feel free, but that is not where I start. My base camp is on the bullish side. I'm not a perma bull, but that's where I start. And I got to see evidence to get me out off of that, position. But anyway, if you are new, welcome. Be sure to like our video today and to subscribe to our channel. We'd love to have that. If you want to learn more about earnings beats, you got a couple of options. Number one, we have a 30-day no-cost trial to our full service. So you can always check that out. That does require credit card. The one that does not require credit card, however, is just a simple subscription to our free Earnings Beats Digest newsletter, which is published 3 times a week, Mondays, Wednesdays, Fridays. Normally, we try to get this out about an hour before the stock market opens. Sometimes it's a little bit later than that. If it is, you're looking at the culprit. It's usually me to blame. I'm normally just late getting it to our team to get it posted and sent out. But all it takes is a name and email address. Hit that subscribe button. We'll get you set up. Again, no credit card required. You can unsubscribe at any time. It's a simple read, 2 paragraphs in a chart. That's all it is. 2 paragraphs in a chart. You'll be on your way, but it'll give you some little bit of information about how we approach the market and also potential stock trades. I mean, that's completely up to you. You can look at the chart, decide for yourself if you like it, you don't like it. Be sure to watch your entry, your target, and your stop levels. Make sure that reward to risk makes sense. But yeah, I mean, we've got a lot of folks who have written into us telling us they've taken advantage of some of these trading opportunities, as well as just learning a little bit more about how we approach the market. So make sure you check that out. For today, the chart of the day, what I wanted to just talk to you about briefly was UNH. They reported on Friday. They beat on the bottom line. I'm not sure about the top line. I haven't gone in and dug into a lot of these earnings reports from Fridays enough just yet. But you can see on the chart here, UNH back down near a recent low. And if you look all the way back to April, you'll see a high that was around 520. And then when we broke out above 520, we came back down, closed at 520 before we had another new high. And then coming back down here, we had one head fake below 520. But other than that, we had been holding 520. So where did we gap down and close at? Right around 520. So this is a major support area. I do believe if UNH loses that intraday low from Friday, I'd be a little bit careful with it until it begins to show us that it's got some strength and some relative strength. But that move back down on Friday was not exactly what we wanted to see. And if we pull up relative strength, look at UNH relative to the healthcare provider index. It was sailing along till the end of November, but since then it's been dropping. And with that earnings report and close on Friday, it actually dropped to its lowest level on a relative basis in about 4 months. That's not what I really like in my stocks. So it is at support and maybe it bounces off. But if I lose price support, knowing that the relative strength has been dwindling now for the last couple of months, that would probably keep me or get me out of the stock. So if you are playing a support level on UNH, at least consider the fact that relative strength has been dropping, and this price support, if it's not held, would not be a very good thing. Finally, look down at the bottom. Healthcare providers, which were showing strength back in September and October relative to the S&P, have been dropping. So you've got money that's been rotating out of this group over the last couple of months, and you've got money that's been rotating out of UNH relative to the group. So instead of having a leading stock in a leading industry group, you kind of got a lagging stock in a lagging industry group. And that is an area, or that's the type of investment I'd be very careful about. And if I did, play a support test. Just keep in mind, if it loses that, I'd keep a tight stop on it. All right, let's talk a little bit about an article I wrote on Friday. On Sunday. So I wrote an article and I just said, be careful with technology stocks. If you look at it right now, I'm not saying in the short term that right now technology is going to go back down. Maybe it does, maybe it doesn't. But what perspective and history are telling me is that this advance in technology continuing this move to the upside is probably a lower probability than moving back down and perhaps giving way to some other areas to lead for a little while. And you can be in a secular bull market and be lagging in technology. Doesn't happen often, but you can see that move, that rotation into more value-oriented areas. And technology can just kind of go along for the ride or maybe lag a little bit, and the market can still go higher. So a couple of things I wanted to point out from the article that I wrote. First of all, this is an annual chart. Now, I don't do annual charts very, very often, but this is an annual chart dating back to 1925, 100 years ago. The red-filled candles are basically showing you the bad years in the market. And the ones that are hollow are showing you the good years in the market. When you look at this and you're going into a new year, explain to me how you can just go into every year. And I'm talking about the perma bears. If you're a perma bear and you think this market's always fixed, always, somebody's, just pumping it up and it's inflated and it's going to come crashing back down. That's your approach every year. Explain to me this chart over the last 100 years, because I see a lot more hollow candles than I do red filled. Are we inflating the market for the last 100 years? This has just been a little game, and all the people that have made a lot of wealth in the market over the years, is it really not real? Because I'm looking at it, I'm thinking it's pretty darn real. Don't go into every market thinking it's going to crash. I don't understand this mindset that most people have, and many analysts. I just don't get it. And yes, I rant from time to time because I have the charts to back me up. I don't know what everyone else is so fearful of year after year after year after year after year. I just don't get it. We have such great innovation in this country. It's set up for the most part. We got low interest rates, historically low interest rates, even though they've gone up. We're talking about under 4%, right around 4%, 10-year Treasury yield. We've got inflation coming down, which historically means the market goes up. Go back, look at the late 70s and into the 80s when we finally got inflation under control. We went into one of the biggest bull markets in our history. Probably was the biggest bull market of our history, 1980s, 1990s. We got inflation coming back down. Why are we going to go into this year, other than the fact that we had a good year last year, and maybe for a period of time we got an election year? We got reasons maybe to be cautious, and perhaps we see a little pullback, but I'm talking about secular bear market. Why are we thinking secular bear market? I just don't get it. Anyway, moving on. The S&P 500, one thing I wanted to show you and why I'm a little cautious right now is here is our 15-year uptrend. And you can see we get outside the trend lines here. We did it at the end of 2021, which was one of the biggest reasons why I didn't like the market going into 2022. Look at this channel. When you go outside of a channel that's 2 weeks old, okay, that's not really that big a deal. Channels I'm not really concerned about a 2-week channel. This is a 15-year channel, connecting these lows, dragging the slope of the line up to connect these highs. When you go outside to the extent we did in 2021, perspective, just having a little bit of perspective, rising 115% in 22 months, breaking out of this channel, now it's easy to look back, right? The hard part is looking at it in real time. But we talked about it at Market Vision 2022. This move to the upside was unsustainable. All right. So now let's talk about just the last 2 months, because this is a daily chart. And I put down here the rate of change over the last 41 days. Why 41 days? That was from the low October 27th to the high on December 28th, 41 trading days. And from there, you can see that we had, or maybe, yeah, well, I think it went through the end of December. So we got up to 16% over those 41 days. Look back this century and see how many times we made a 16% move over 41 days. And you can count them on two hands. Here, the biggest ones were coming out of the 2009 secular bear market, and the other was out of the pandemic. These were out of crazy lows where, if you were using perspective, and if you know the history of the market, when you do have these kinds of sudden crazy drops, the recovery you get is the best move you're going to get. So that's what we saw here in those two. So those were two extremes. These were mark the bottoms, crazy panic, all of that coming out of that. Take those two out of the picture, though. I mean, what we just went through over the last 41, or those 41 trading days through December 28th was close to the best thing we've seen in the entire 21st century. So would it not make a little sense to pull back a little? That's all I'm saying. I'm not talking about a bear market, secular bear market. I'm not even talking about a correction, which would be 10%. That's what normally is discussed with a correction. I'm not even talking about that. I'm just saying, hey, 3 to 5%. Would it really hurt at this point, given that kind of move to the upside? Now I'm going to skip over all the wording, and I'll take you to the technology chart relative to the S&P. I know the market just opened, so I'll try to wrap this up quickly. But here's the XLK relative to the S&P 500 over the last 10 years. And once again, if we definitely have seen periods where we got crazy. After the pandemic, we went crazy. This was just a tremendous rise in technology stocks. We've come back down, or we came back down, went back up one more time at the end of 2021. Again, look what happened during the 2022 cyclical bear market. We went all the way back down to the bottom of this channel. But 2023 was a really strong year for technology names. And look at us, we're up here battling that channel line again. Would it hurt to just pull back a little bit on a relative basis, or just run along the channel line? In other words, just kind of go along with the market a little bit here, but not necessarily lead. Look at the PPO, relative PPO. We just recently got up to, and this was back in the middle of 2023, the highest level we've seen over the last, throughout the secular bull market. So it just seems like technology is at a level where maybe we continue to see this drop down in the PPO, and maybe we pull back a little bit. It doesn't have to go to the bottom of the channel, and I don't believe it's going to the bottom of the channel, but just even somewhere back into the channel would seem to make sense to me. And you can see the rate of change, 52 weeks. This is a weekly chart, by the way. So when we're looking at this, pull up a 52 week, that's a 1 year relative chart. And you can see that we had made a massive move on a relative basis. This is the rate of change for 1 year. And look what happened after we did it in 2020. We came crashing down. Now, I don't know that we come crashing down, but I wouldn't be surprised to see the technology group, maybe meander sideways to slightly lower throughout 2024, or at least at some point in 2024. So that's kind of another reason. Now, here's the final chart I'll show you. And this is just the absolute chart of the XLK. So this isn't relative to the S&P. This is just the absolute price chart of the XLK. And you can see if you connect all the lows and then use that same slope line connecting the highs, you can see what happens. Here we get up to the channel line, sideways consolidation on technology. Channel line, sideways consolidation. Channel line, sideways consolidation. Then this whole period here, we're kind of in the middle, nothing really big, major. And then right before the pandemic, we were up near the channel line, come back down, test the bottom channel line. 2020, 2021, we go through, we're outside the channel, just like we were on the S&P 500. Cyclical bear market brings us right back in. Look at where we are right now. We tested the channel line back at the beginning or middle of 2023. We had a little correction. Market, remember, we corrected. And now here we are again. So would it be a horrible thing if the XLK were to simply just go sideways, or maybe just go up slightly along the channel line? But to think that technology is just going to continue to explode higher relative to the S&P 500, where we've been and where we are there, and then looking at an absolute chart and seeing that we're at the top of the channel there. Again, I'm not making any major call about technology getting killed. I'm looking at this and saying, let's keep perspective in mind. We've made a big move in technology, and you can see it on these charts. And we have a history of seeing not great action when we've been up near the top of this channel line. So if money is coming out of technology on a relative basis, and maybe even on an absolute basis, that could set up other areas of the market to carry us. You can go under the All Stock Charts blogs menu and just go down to trading places, and you'll find all of my articles here in chronological order. You got a blog archive. You can go back over the last few years if you want to see what I was saying at various points in the market. Feel free. We don't have anything to hide. I love that StockCharts has these archives. You make the calls, the best calls you can make based on the circumstances at the time. I'll stand by my calls. I think ultimately the market goes higher, but I do see the first quarter being choppy. Anyway, let's see what the market's doing right now as we get ready to, or as we open up a new week. We got the Dow Jones down 4.41%. S&P, Nasdaq similar, just a little bit better than the Dow. Small caps continuing to get hit. That is not a good sign for the IWM. I think we could definitely see us moving back into the mid 180s range on the IWM. I wouldn't be surprised. And volatility index has jumped up $1 or 120 to 1390. So that's up 10% today. I don't know if that holds or not, but I wouldn't be surprised by a move in the VIX. If we do see short-term weakness, I wouldn't at all be surprised to see the VIX up at 15 or even above 15. So anyway, that's the way I see it right now. A little bit cautious. One thing I didn't even mention was we have a lot of in-the-money call premium. And Friday is monthly option expiration for January. So that, even if we go up, if we manage to rally later today and go up the next couple of days, as we get closer and closer to option expiration and into the week following option expiration, history tells us we really need to be careful. So there's a lot of things coming together here. If you've made a lot of money here on this rally, it wouldn't be a bad time to just pause and kind of see where the market goes here. Also, Thursday marks the end of the most bullish period of the year historically. October 27th close to the January 18th close. So that period has gone up now like 63 times in the last 74 years. It's a pretty strong percentage chance that you're going to go up during this period. And this was one of the best ever. So again, another reason maybe to kind of pull back on the reins here a little bit in the short term. I really don't think we're going to see a runaway, or I'm not even runaway, but I don't think we're going to see big rallies in the stock market to the tune of more than 5% until we get past probably the first quarter, maybe into April. So I just think it's a different market to try and navigate right now. And again, it is an election year, and this is how the first quarter of election years typically play out, with a lot of chop. So anyway, be careful out there. I'll keep giving you my take on it as we go throughout the quarter and throughout 2024. Overall, I don't think it'll be a bad year, but I do think there are going to be pockets where we need to be careful. And I think right now is one of those. Have a happy day. Have a hopefully a successful trading day. And I'll see you all tomorrow. Don't forget our members, our paid members, full service members. We do have a live trading room on Wednesdays, and that'll be at 10 a.m. Eastern tomorrow, a half hour after the market opens. So another reason to take us up on that 30-day trial. We'd love to have you. I'll be back tomorrow morning for your next Trading Places Live. Happy trading, everybody.